Welcome to This Explainer. I am so glad you're joining us because today we're cracking open a pretty fascinating survival guide. We're going to look at exactly how the National Stock Exchange, the NSE, acts as an absolutely ruthless gatekeeper for companies trying to go public on their Emerge platform. If you've ever wondered how the market actually keeps the bad actors out, well, you're in for a treat. So let's just jump right in. I want to throw this question directly at you. What actually stops a company from going public? I mean, we hear about IPOs all the time, right? But what you almost never see are the ones that get bounced at the door. Today, we're going to uncover the exact regulatory red flags that get a company's application sent right back to them by the exchange.
Here is our quick roadmap for today. First, we'll look at the Emerge platform gatekeeper. Then, financial flaws and phony numbers. Third, vague goals and missing plans. Fourth, legal landmines and hidden risks. And finally, the consequences of bounced drafts.
All right, part one, the Emerge platform gatekeeper.
Think of the NSE Emerge platform as a super exclusive club. To even get past the bouncer, you need your ID, which in this case is the draft offer document. This is the massive, comprehensive application and deep dive disclosures a company has to file with the exchange. And listen, if this document is fake, if it's vague, if it's missing crucial info, or worst of all, provides false data, the exchange has really broad guidelines empowering them to just hand it right back. Access denied.
Now, crucially, this isn't just some automated robotic checklist. Just triggering a criteria doesn't mean an automatic rejection. Actually, scratch that. It's more like the exchange uses these guidelines as a starting point. They reserve the right to reject drafts based on the actual materiality of the findings. They're looking at the real substance, the specific facts and circumstances, not just checking off boxes.
Moving on to part two, financial flaws and phony numbers.
This is, without a doubt, the most heavily scrutinized part of any application because it deals directly with the company's money. Contrast a healthy, consistent financial trend with what we call a sudden spurt. Isn't it just incredibly convenient when a company's profits or their working capital estimates magically double right before they ask the public for cash? Yeah, the NSE thinks so too. If a company can't provide rock-solid, verifiable reasons for massive, sudden jumps in income or assets right before filing, well, that's a massive red flag.
Let's break down some other financial illusions that'll get an application instantly tossed. Circular transactions, especially with connected entities, are a huge no-go. It's basically a shell game to artificially inflate net worth and create a completely exaggerated business model. Then you've got unidentifiable promoters. I mean, if the exchange doesn't know who's actually running the show, there is no way you're getting approved. We also see companies literally changing their accounting policies just to fake better prospects. And finally, if the auditors raise doubts or fail to grab the required UDIN, that's the unique document identification number for the financial statements, it's game over. Investors simply can't assess the risks of a business model that's built on smoke and mirrors.
That brings us to part three, vague goals and missing plans. So what happens when a company wants a ton of investor money, but they have absolutely no concrete idea how they're going to spend it? Look at these literal pipe dreams. A company might say, hey, we're going to use the proceeds to purchase plant and machinery. The reality? They haven't even identified the land to put it on yet. It's completely absurd. Or they ask for funds to set up a whole new plant, but they're missing the essential competent authority clearances needed to even start. The exchange demands concrete steps, not fantasies. And the scrutiny doesn't stop there either. Here are a few more vague objectives that get shut down fast. Asking to fund working capital without any past trends to back it up. Trying to repay undocumented loans, like where did that money even come from in the first place? Proposing this huge, unreasonable time gap between raising the funds and actually using them. And oh, this is a common one. Asking for cash to spend on intangible assets, like brand building, without a highly concrete business plan. The bottom line here? If you can't prove exactly how the funds will create tangible assets or demonstrably benefit the business, the exchange is not letting you take the public's money. All right, part four, legal landmines and hidden risks. Now we're digging into the skeletons in the closet. There are some severe legal red flags that will stop an application dead in its tracks. We're talking about pending litigation that's so massive, the company's very survival is on the line. We're talking willfully concealed material facts. Then there are procedural disasters, like failing to resolve a conflict of interest with the lead manager. And get this, some drafts actually list entities that aren't even registered with CB as an advisor to the issuer. I mean, hiding lawsuits or using unregistered advisors isn't just sloppy, it's a direct threat to the core eligibility criteria. And the NSE is incredibly strict about how you communicate with the public. Risk factors absolutely cannot be vaguely worded. They have to quantify the risk in simple, unambiguous language. You can't just bury the danger in confusing corporate jargon. Plus, basic compliance failures, like promoters not having their shares in dematerialized form, or literally forgetting to include a required chapter in the disclosures, those will trigger an immediate return. No questions asked.
Finally, Part 5. Consequences of bounced drafts. So what happens when you actually fail the test? Let's walk through the fallout when the gatekeeper hands that draft document back. It is not just a minor delay, it's a massive procedural headache that triggers a mandatory domino effect. Step 1, the document is returned with reasons. Step 2, the exchange sets a specific cooling-off period, determined on a case-by-case basis depending on how bad the emissions were. Step 3, the issuer and lead manager have to fully address the insufficiencies. You can't just put a Band-Aid on it. You have to fix exactly what was wrong. And then Step 4, only then can you resubmit in full compliance. But there's one really powerful number you need to keep in mind here: 0. If an application is returned by the exchange, or even if the company just decides to withdraw it, there's absolutely zero refund of the processing fees. The money is just gone. And if losing the fee wasn't bad enough, it actually gets worse. Having the application returned might just be the beginning of the company's regulatory nightmare. The guidelines explicitly state that returning the document does not prejudice the exchange's right to initiate further legal action. Meaning, if they found something seriously non-compliant in your draft, they can and absolutely will come after you legally. So, as we wrap up this explainer, I want to leave you with a thought. Does knowing about these extremely strict regulatory roadblocks make you more or less confident in investing on emerging market platforms? We've seen how meticulously the SENC hunts down phony numbers, vague pipe dreams, and hidden legal landmines. These rules aren't just red tape. They're a literal shield protecting everyday retail investors from absolute disasters. Thanks so much for diving into this with us today. And remember, always keep asking exactly where your investments are going.